Actively managed ETFs are a pretty cool newer investment product that some people argue will be the primary or the dominant investment vehicle for many years into the future. Of course, everyone is really familiar with ETFs by now. They're typically much cheaper in expense ratio than traditional mutual funds. They're easier to trade. They are more tax efficient in a taxable or non-qualified account. They have a lot of advantages that make it easier for investors to invest their money. And because of this, flows into passive investment vehicles, mainly ETFs, has drastically outperformed the flows that we've seen into actively managed mutual funds, which were the most popular investment vehicles throughout the 1980s and 1990s. ETFs have kind of really taken over the investment market. Most ETFs are indexed or passive investment strategies though, and a lot of people are arguing that passive investment strategies are in a bubble or that passive investment strategies will not remain as popular as they are now into the future. I personally agree with that argument. You can check out my video on those topics later. But an actively managed ETF is kind of the best of both worlds in a certain sense. It is still an ETF vehicle, so it's relatively cheap, but it's easy to trade and it's tax efficient. However, you get some manager decision making that goes into the investment strategy so that you're not just blindly buying an index. For example, in the small cap space when 33% of the stocks are actually not profitable, or in the large cap space when Tesla gets added to the S&P 500 and instantly becomes like 20% of the index, or weird scenarios like that. So an actively managed ETF is an exchange traded fund still, but it has an investment manager or an investment managing team making decisions on the investment allocation. They are not adhering strictly to a passive or a set investment strategy, so it really is active. But actively managed ETFs don't usually involve full discretion like an actively managed mutual fund could. And that's an important distinction to make from traditional actively managed mutual funds. Full discretion in that example would be like a large cap manager who could put 75% of the fund in 3 large cap stocks that make up a tiny portion of the index. Usually an actively managed ETF gives the manager or managing team some leeway into like how much they allocate towards each sector, but they still have to have within a 10% benchmark allocation of each sector weight or something to that effect. So that's why I say actively managed ETFs have some decision-making power, but not discretionary trading power like an actively managed mutual fund. With mutual fund investing, a lot of people would say you are buying that manager. Sometimes you give them complete reign. There are all cap mutual funds that their prospectus allows them to go from anywhere to 0% to 100% cash, and they can buy any stock in any investable universe, US, emerging market, large cap, small cap, anything out there really that's available for trading. This can work out really well, and there are some examples of mutual funds consistently beating the market. It can also turn out really poorly. I've seen specifically one small cap mutual fund that comes to mind from a manager who was previously in the hedge fund industry, but he wanted a product that retail investors could benefit from. He had a discretionary small cap stock picking strategy. The prospectus gave him a lot of leeway, and unfortunately the strong track record he had in the hedge fund industry did not carry over to that mutual fund after many retail investors had bought in, I think to the tune of $2 or $3 billion. Relatively small fund, but still, it performed really poorly because the 3 stocks that made up the majority of the allocation in that fund did not do what the manager thought they would. But you also see some certain actively managed ETFs which, from an investment strategy perspective, really don't differentiate from an actively managed mutual fund at all. A popular example now is the ARK ETF lineup, with I think their biggest fund being ARKK. This is an ETF that involves almost 100% manager discretion, even more so than many actively managed mutual funds. The ARKK ETF has like a 98% active share, which just means that the vast majority of its allocation deviates from the benchmark that it is stated to compare to. It also really doesn't save you any money at all on expenses. The expense ratio of that ETF is 75 basis points or 0.75%. The expense ratio of many similar actively managed mutual funds is maybe 75 basis points, 80, 85 basis points. They're all in that range. So you really can throw the cheap expense ratio argument out the window with some of these actively managed ETFs. So really the only difference between a full discretion actively managed ETF and a traditional actively managed mutual fund is just the fund structure. It is an ETF, it's not a mutual fund. The fund doesn't actually buy shares in the stocks in which it invests in, and it's a bit more tax efficient like ETFs are. If you're not familiar with one of those last points, it's good to know because ETFs don't actually buy shares of stocks in the underlying funds that they're investing in, like many people seem to believe. But mutual funds do. So if you put like $10 billion in a mutual fund and they had to invest that money, the volume of those purchases could drive up the stock prices. If you put $10 billion in an ETF, they don't actually have to buy any stock at all with it. ETFs, by their very nature, create what is like a basket of stocks and bases its price, its NAV, net asset value, on the share prices and the allocations to each of those stocks that it holds. Then when people invest money into the ETF, it basically sells to those investors creation units, each creation unit mimicking the original basket of shares of stocks that the ETF was built off of. This is why ETFs are much more tax efficient. There are no capital gains allocations at the end of each year because the fund was not actually buying or selling shares of stocks when there are redemptions. This is also why ETFs have live quotes and can be traded throughout the day like stocks. It's because it's just this one little NAV that can bounce around and is not directly tied to the value of all the underlying investments. The price of an ETF of its NAV can actually deviate if a bunch of people buy the ETF relative to the prices of the stocks in which it holds. There can be a disconnect there. Whereas with a mutual fund, you can only trade it like after the close each day and the order goes through one time, because the mutual fund managers have to actually go out and buy more shares of the stocks in which their fund holds when more money comes in, and sell shares of those stocks that the fund holds when money comes out. Whereas an ETF just gets to create more or delete some creation units and send you your money back based on the allocation of stocks that it holds. Someone asked me how the performance of an actively managed ETF might differentiate from the performance of an actively managed traditional mutual fund, and that's really going to depend on what specific ETF or fund that you're talking about, but there is a distinction there. We'll compare two really popular ones, like I already said, ARKK, and Fidelity's maybe most popular stock mutual fund, which is the Fidelity Contra Fund, which came from the Fidelity Magellan Fund, which was the most popular mutual fund in the world throughout much of the 1900s, really. In a scenario where the stock market is like melting up or having a really sharp increase, it's going to depend on which sectors of the market are increasing and which sectors the actively managed ETF versus the actively managed mutual fund are invested in, of course. And then in a crash, the same rules are going to apply. For example, if we saw a market this year in 2021, anything like what we had in 1999 and 2000, it's going to be the momentum stocks that make a huge run up, as they really have in the last 3 years right now. And then it would be the momentum stocks crashing back down as that bubble kind of collapses. An actually managed ETF like ARKK would do extremely well. It has really concentrated allocations to high momentum stocks, especially Tesla right now. And if the stock market has this big melt up, you can almost be assured that Tesla will be a part of that melt up and the price will keep going up. So ARKK would dominate even a growth oriented actually managed mutual fund like Fidelity Contra Fund. Contra Fund is a much more what I would consider disciplined investment strategy. It's not going to buy the names that just have a ton of momentum. It is really focused on the business prospects of the underlying stocks, current cash flow of the underlying stocks. And so even though it is a growth fund, it's still going to be relatively defensive to something like ARKK, which is so highly tilted towards momentum. But then in 2001 and 2002, the markets subsequently crashed. So if that happened in the year 2022, you'd see a fund like ARKK perform really terribly. It could lose 60, 70, 80, 90% of its value. Whereas Fidelity Contra Fund would certainly lose money, maybe 40 or 50% of its value, or whatever else the broad stock market lost by. So you can see that it just depends on the specific strategies that the actually managed ETF versus actually managed mutual fund is following. Now, if you compare those two to a mutual fund that is buying like blue chip stocks, anything that's more defensive, certainly a large cap value strategy, anything with a lower volatility tilt, focusing on utilities, industrials, discretionary, whatever. Maybe the Dow Jones is a good example of that. It's just 30 stocks, but in the 2001, 2002 recession, tech dropped like 80%. I think the Dow was down 17%, maybe 18%. So there's going to be a huge difference in how each of these investment products performs based on what stocks it's exposed to and what role those stocks play in the melt up and subsequent crash that the stock market sees from time to time. So to wrap this up, actually managed ETFs can be a good part of your portfolio. Don't be tricked into thinking that they are cheap like regular ETFs. They're just as expensive as actually managed mutual funds, but they're in a structure that's a little easier to trade and a little more tax efficient, so it can make a lot of sense. If you've gotten to this point in the video, it means that you watched the whole thing, and I very much appreciate that. The YouTube algorithm loves long watch times in terms of percentage of the video watched, but also just total minutes watched. If you could also like this video and subscribe to the channel, both of those things also help me out, helps the channel grow, and I appreciate those as well. So as always, thanks for watching.